Hey, my name's Dustin with The Simple Dollar. We make videos related to everything to personal finance, so if you're new to the channel, consider subscribing so you don't miss any future videos. As always, we put really good resources down in the description as well, related to everything we talk about in our videos, so make sure you check that out before you leave. And if you enjoyed this video or get any useful information from it at all, we'd really appreciate it if you drop down and hit the like button too. So there's something known as home country bias. It's what we see with investors all over the world. They have a tendency to invest in their home country more so than other countries. Let me know in the comments where you're from and if you do the same thing. In reality, there are some benefits to investing in your home country, but there can also be some downsides, and that's what we're going to go through. We're going to start with the benefits of investing abroad. And the first one is diversification. So imagine that you invested into Apple stock. iPhone sales begin to decline. That's probably going to hurt their stock price. Now, if Apple is the only stock that you bought, that's going to hurt your entire investment portfolio. If Apple is just one of many stocks that you bought, then iPhone sales going down isn't going to impact your portfolio all that much because it's just going to impact one small piece of your account. The same logic applies to investing internationally. If something happens that's specific to the US and it doesn't impact other markets, then if your investment dollars are spread around the world, something happening specific to the US won't have as much impact on your total account. We'll leave a link in the description to more information about how helpful diversification can actually be to your account. The second benefit of investing internationally is it actually lowers your volatility. A study by Vanguard in 2012 found that a portfolio made up of both US and international stocks performed better in terms of volatility than just a US only or an international only stock portfolio. While there's no guarantee that this is going to continue in the future, in the past having both domestic and international stock exposure has limited the volatility in your portfolio. Which leads us to the third pro, which is a possible rebalancing benefit. So let's say that you have an asset allocation strategy and you're going to be investing 60% of your stock money into US equities and 40% of your stocks are going to be international. While the expected return for the two groups is pretty similar, there's a chance that one could move up faster than the other. So say you invested and you're originally at a split of 60-40, and then US equities ran a lot faster than international equities. That may lead you to a new allocation of 70-30. What you would then do is sell your US equities, buy your international equities to get you back in balance of the 60-40. And so you think about what this does. We're selling the piece that has gone up the most and buying the piece that either has gone up not as much or maybe has even gone down. That essentially forces you to buy low and sell high. And it does so with the rules-based approach that takes a lot of the emotion out of investing. If you want to learn more about asset allocation strategies, we'll leave a link in the description below. So those are just a few of the benefits of investing internationally. Now what about some of the downsides? So one of the main downsides is that often international funds, if you're going the route of investing through a mutual fund or an ETF, they generally have higher expense ratios than US funds would. You take the Vanguard US Total Market Index Fund, for example, it has an expense ratio of 0.05%. You compare that to the International Total Stock Market Fund, it has an expense ratio of 0.12%. That's not a huge difference, but it is something to consider. The second downside is that it adds a layer of complexity to your investments that you wouldn't have otherwise. The unfortunate reality is for a lot of people, just getting started is enough of a hurdle to get over. Adding in an additional layer of complexity just only compounds the issues. You consider there's thousands of different funds, ETFs, mutual funds that you can be investing in. If you want to add an international fund or two to your portfolio, you're adding additional complexity, something else you have to know, understand, and then monitor over time. One option to circumvent this is through the use of target date funds. They automatically rebalance your account over time. And if you're not familiar with target date funds, we'll leave a link in the description below to check those out. So now that leaves us with the question, okay, so we want to use international securities, international funds. How much should we be putting towards international versus domestic? And the short answer is, it depends. The amount that you put into international stocks should really be in context of your overall asset allocation strategy. To give you a frame of reference, the MSCI All World Index is made up of about 45% international market cap. That means that about 45% of the global market is based outside of the United States. With Vanguard's research, they suggest a minimum of 15% of your stock portfolio to be allocated to international funds. funds. Personally, I invest about 30% of my stock portfolio to international companies and international funds. There is no one size fits all. One thing to consider though is that even investing in US companies, a lot of those have international exposure because they're global multinational corporations. So even if you invest in just US companies, you're likely getting some international exposure already. Another thing I would caution you against is trying to force yourself to invest internationally. If you're just investing in, say, a 401k and you've got limited fund options, and they only have like a really bad fund in there, maybe it's a high expense fund. Expenses are one of the few things that you can control in terms of your overall investment performance long run. So the benefits of investing internationally are probably going to be outweighed by the high expense of the fund. If you want to read more about international investing, make sure you check out the description with the link over to the Simple Dollar so you can read up more over there. And if you enjoyed this video, I'd really appreciate it if you hit the like button. Make sure you subscribe if you haven't already. And for the Simple Dollar, my name's Dustin. I look forward to seeing you again soon.